Welcome to a brand new show of Market Makers. Well, election volatility, is that behind us? Is it back to basics now? Is it time now to really get back into hardcore long-term value investing? If yes, in this kind of a market, where are the values? How next 5 years would be different from last 5 years? Is capex the new capex, which has been the evergreen, which has been the leadership theme? Will that continue? Or given that the complexities of the market are changing, a new leadership is likely to emerge. Let's take that point forward with Milind Karmarkar to talk about markets, value investing, and where is Trent headed. Lots to discuss. Lots to discuss. We've seen all shades of markets last week.
Yes, absolutely.
Euphoric high on Monday, panic low on Tuesday.
Correct.
Bout of short covering on Wednesday and Thursday, and a great follow-up on Friday.
Yeah.
Where are markets headed?
So actually, again, as always, I go back in history. So, in fact, 2002 to 2008, that period was one of the best periods to be in the markets because you saw the best, you saw the worst, you saw what happens after a coalition comes in power, you see what happens when a liberal party like Congress is supported by communists, the market goes down 20%, and after that, the market goes up 5 times. So, you have seen that happen. I think we are seeing a repeat of that. I'm not saying that the market will go up 5 times, but I'm seeing a repeat of that. So we are seeing, as you said, huge volatility, not the kind which we saw earlier, but still a huge volatility. And now we have a government which is a coalition government, all said and done. Though BJP has a significant number of seats, but it's a coalition government, and there will be coalition politics will come into play. So my belief is that whenever a coalition is in the at the center, then you see a decent growth. The clear focus is economics. The clear focus is to do better for the masses, and that is what drives the markets. That is what drives the economy as well.
And if one looks at the history of last 20 years, I'm not taking a leaf from your answer, markets have done rather well during the coalition period.
Absolutely.
Also. So this entire mindset which everyone has that the new government and new abki bar coalition sarkar is not good for the market, that should be dismissed.
Very true. Absolutely. That should be dismissed completely.
So let's understand the market contours. The leadership in the market is very well defined. Capex, policy, railways, defense. Will that leadership continue?
So my view is that frankly, now the market is far better discovered than what it was in 2003-04. There are so many analysts, there are so many funds, and everyone is researching companies. So according to me, market is fairly discovered market. There may not be a single theme which will drive the market. The only mega trend which I see, and I have been talking about it earlier also, is consumption and rising per capita income. So whichever industries benefit out of that will continue to do well. Within that, of course, there is a shorter, smaller trends which are also there, like you said, whether it's railways, whether it's power. But again, there is a slight difference here. What will happen probably is that the PE expansion will not happen going forward. You will get the returns which earnings will give you. The P's may remain where they are.
You don't expect them to come down?
I don't see it immediately.
Okay.
5 years down the line, I don't know. But immediately, at least, it's unlikely that the P's will contract, especially in themes like railways, power, and these, because there is a growth path, defined growth path there for next 4-5 years.
Okay. Last week we saw that there was a complete change of gear, reverse gear in terms of the stock outperformance, and fifth gear in terms of outperformance.
Yeah.
FMCG made a comeback, autos made a comeback. The general view is that a coalition government means you need to fix the rural economy. You need to take care of the distress in the rural India, which means more money in the hand of consumer, and that anything which has got to do with more money in the hand of consumer, that theme made a comeback.
Correct.
Do you think there is merit in thinking like that?
So again, if you look at companies like, say, Hindustan Unilever, what one should realize is that it's a deeply penetrated market. You go to a small village, you will find a sachet of surf, a sachet of shampoo, and so on and so forth. So I don't see a significant growth there, but yes, the sluggishness in the economy will go away, and because of that, they will be able to deliver 8 to 10% growth. So that is definitely there, but I think they are already priced for that. But typically, whenever there is volatility in the markets, much of the money, smart money as you call it, moves to these places like whether it's FMCG or whether it's technology.
If somebody is buying these stocks at 70, 80p multiples, is that smart money? I don't think that is smart money.
No comments. No comments.
That is not smart money.
But yes, for the shorter period of time, people feel that there could be uncertainty, so they move to these stocks. Like technology did a good comeback last time. Because again, technology is not dependent on Indian economy, it's more dependent outside. Again, if you ask me, how do you think the outside economy will do? I have no answer for that.
IT sector is growing in between 5 to 8%, depending on the company you look at.
True.
I think a double-digit growth is still a distance away. It's not going to happen in FY25 for sure.
True.
To FY26, we don't know.
Yeah.
So I just wonder what is so defensive and what is so smart about it when you're buying into a sector.
As I said, no comment, Nikunj.
You've not bought IT and FMCG.
No, I have not bought anything.
What did you buy on Tuesday's fall? Or what did you buy in Tuesday's fall?
So, I did buy whatever I had in the portfolio. I didn't go and buy something new.
Okay.
But I found a good opportunity when Larsen & Toubro fell. So we bought Larsen & Toubro. I found a good opportunity when Trent hit a lower circuit. So
Trent hit a lower circuit?
Yeah, it did for some time.
Okay.
And 10% down. So we bought where we had not been able to buy earlier because it was trading at slightly expensive valuations than what we thought, what we think in the shorter term. But we got this as an opportunity. So we sort of upped our weight in Trent in the newer portfolios. Older portfolios, there was no change.
You know, when there's a shakeout in the market, and this time the shakeout lasted for barely few hours. It did not last even for fairly few weeks.
Correct.
Normally shakeout, they last for a few quarters.
Yes.
Now because of technology, awareness, a lot of other factors, the shakeout lasted for few hours only,
Correct.
or few days. The leadership historically changes when there is a shakeout. So do you think that the leadership in the market is unlikely to change or will change because of this Tuesday shakeout?
So let me put it this way, that as of now, if you ask me, apart from these railways or power or some of these, there is no leadership in the market as of now. The entire market has moved up. So whether there will be a new leadership kind of a thing, I really don't know. But at the same time, I have confidence that the market will grow for next 5 years. And because of that, again, as I said, that I still believe that the mega trend is growth in the Indian economy and growth in consumption or growth in per capita income. So anything to do well, what has probably not participated, it has participated like most of the other markets because of sentiments, is pharmaceuticals. They have not participated much. And I have, many times I have spoken about this, that affordability is the key factor for growth in Indian pharma, especially India-focused pharmaceutical companies. And if you believe that your per capita income is moving up from $2,500 to say $5,000 or $6,000, then pharmaceutical companies which have not actually participated in last 2-3 years could participate.
That's about it.
Yeah.
Okay. Let's look at PSUs in general, because everything which had a suffix PSU or a prefix PSU, that has moved up. Will markets now start differentiating there?
I think they should start differentiating. But because if there is earnings growth, then you look at the PE and then you decide whether to buy or not. But otherwise, anything to do with PSU going up, I think it was a sentiment-driven rally, which in all probability will stop.
Where are excesses in this market?
PSUs.
There are excesses.
There are excesses in PSUs.
But you will keep railways and power aside?
I will keep railways and power aside, but if you see in the last 6 months, they have gone into a time correction. So we have not bought anything in railways and power for last 6 months.
Your last purchases were what, beginning of the year?
Yes.
Or
Yes,
that's the time you bought into new
beginning
ideas?
Of the year.
And you bought into capex and you bought into few railway stocks?
Yeah, correct.
Let's understand the entire capex theme. And I'm keeping railways defense aside.
Yeah.
There is a manufacturing renaissance in India. That's what they say.
Yeah.
So whether it is an area of AMS, whether it is an area of energy transition, or whether it is also in the area of EV transition.
Yeah.
What do you like within manufacturing?
Within manufacturing, I think what we have bought into is predominantly power ancillaries. Rather than betting on power generation, we have bet on power ancillaries, and I think they will continue to. They have a long growth path. So they will continue to do well.
If one looks at power, there is utilities which have done rather well, and the general view is that India will consume more power.
Yeah.
Utilities are in a good spot now. They're no longer dependent only on state government wins and FAMCs in order to revive and survive.
Correct.
Do you think one should revisit power utilities?
So power utilities have already done well, and possibly they will continue to do well because there is growth in that sector. So there is many of these companies are putting in new power plants and things like that. So there is definitely growth in that sector. And because of that, that will continue to do well. But at the same time, I'm very clear that PE expansions are not possible. So now you have to bet for what kind of growth they deliver. And then if you think that the P's are correct, you invest.
What is the benchmark you look at when you're buying a stock in terms of the growth? What is your assumption? What kind of growth you want when you're buying a stock?
So whenever I meet a company, my question to them is very simple, that you have a 7 to 8% GDP growth, you have a 4-5% inflation. So overall, there is a 12-13% growth inherent in the economy itself. So unless and until you are able to grow at 25, anywhere between 25 to 50% higher than that, I will ultimately not be able to beat the market. So anything between 15 to 20% is the kind of growth which I would like to, and that growth should be there for a longer period of time, anywhere between 5 to 8 years. So when I look at that, then obviously it's very clear that the environment should be such that this is possible. And that is the reason why I ask the companies that whether they can grow at 15 to 20%. If the answer to that is no, I mean, it's possible. I mean, there may be a very good company, like if I go and ask Hindustan Lever whether you will grow at 15 to 20%, obviously they will say that it's not possible because they are deeply penetrated. So even if per capita income goes up, it is deeply penetrated. And that is the reason why I look at retail always, because long back, if you see in the US, most of these FMCG kind of companies were the market leaders, which then gave the baton to the retailing companies. And that is the reason why I think retailing will do better than these companies. But 15 to 20% growth has to be there, otherwise I'll not be able to outperform the market.
Okay. What is the P multiple you look at when you invest in these stocks? Let's say you identified a company. There are several companies in India which you can say, okay, 15 to 20%, 3-4 year growth is visible. But how much of that is in the price? How much of that is not in the price? What's the benchmark of P?
If the opportunity is such that they can grow at 20% year on year for next 15 years, then I will be willing to give a higher P. But if the opportunity, like especially in manufacturing, because we have seen that happen earlier also, 2003 to 8. The classic example, the P's went up to 60, 80, and then they collapsed. Some collapsed, some went into a time correction for a very long period. So if between 2008 and 2018, none of them delivered any growth. So it can happen that way, that they may go into a stagnation, or effectively they will continue to have their sales growth, they may continue to have their profit growth, but their stock price will not grow. So that can happen. So that is the reason why PE multiples can be different for the way the company is growing.
Fair point. Now let's look at one important ingredient, which is debt.
Sorry?
Debt.
Yeah.
How much debt levels are you comfortable with when you're investing in a company?
So frankly, if you ask me, most of the companies which we have, apart from probably Larsen & Toubro, they are all zero debt.
Okay. Is it a compulsion which you follow that you avoid companies with debt?
So it is not a compulsion. It is not a compulsion. But what happens is that if you have a very high ROC and very high ROE, then I will think of companies with a slightly larger debt. At the same time, as I told you, we also manage a Sharia fund where there is debt is a big no-no. So that is the reason why, and our thought process is also that when you are looking at a company, debt is all right. But unless and until it is comfortably below the ROC which the company generates, then you buy that company, otherwise you don't buy.
So by that yardstick, would a Zomato or a Paytm, or for that matter a Policy Bazaar, never make to your buying list?
So Zomato, as I said, that Zomato we had bought a few quarters back when they turned positive. So I told you that time also that unless until they turn cash positive, we will not buy it. So we did buy Zomato. We are holding on to it because they have a large cash portion and they can continue to probably grow. But we are keeping an eye because we think that even now it's still a metro-centric phenomenon. Whether it is able to penetrate in in the rural, forget about rural, but semi-urban areas also we have to see. We have bought it, but we are continuing to keep a watch.
If you like this video, then like, share and subscribe to ET Now.